Hello grade 8, I'm on page 10 of your accounting booklets. This is a summary of all the classification that takes place in the previous pages of this book. So this is just a summary. So in the end you should be able to know that non-current assets include land and buildings, vehicles and equipment, and current assets include cash, bank, debtors, trading stock, cash float and cash register. Okay, and then also that owner's equity includes 4 different categories, which is expenses, drawings, income and capital. And then lastly, liabilities consists out of non-current liabilities and current liabilities, and you should know all the examples. So if I tell you mortgage bonds, you should know that it's a liability, and specifically a non-current liability or long-term liability. Alright, just going into depth for each one of them then. Non-current assets, another name for that is fixed assets. They last for a period longer than 12 months. Now what is an asset? An asset is something that you use to generate some income for the business. Okay, so all kinds of income can be generated by having more assets. For example, land and buildings, people rent it out and then they get rent income from the buildings. Vehicles are used to get the employer to work or maybe to transport goods to different locations, and that's why it's an asset. It brings in income for the business. Equipment can be things like computers, laptops, it could be data projectors, it could be tables, etc., tables and chairs within a business. Let's take the school as an example. If we have the chairs and tables within the classrooms, you as students will be able to sit on them, and the school will be able to charge school fees to your parents, and that's an income for the business. So that's why equipment will be an asset to the school. The school bus would be something that's a vehicle that will be used to transport learners to and from the res or to events, etc. Alright, so that's non-current or long-term liabilities. What does it mean? You keep it for periods longer than 12 months. Current assets, on the other hand, will be things like cash, physical cash or money in the bank. A debtor, again, is somebody you sold to them but they haven't paid you yet, and those people are called debtors. Alright, trading stock is whatever you sell within the business. If you sell stationery within the business, then stationery will be classified as trading stock. If you sell equipment like computers, then that equipment will be trading stock for your business. Okay, then cash float, that is the money that's in the cash register when you start your day. When you start your day, for example, there's 400 cash float so that your customers can come into the business and that they can then you are able to give them change. You are able to give them change when they pay and they need change for an item. Alright, so that's assets. Now, just looking at assets, I'm going to show the T account. Assets become more on the debit or left hand side and become less on the credit side. So that's the accounting rule for assets, which we will look at a bit later as well. Owner's equity can be seen as the value or worth of the business. It could also the net worth of the business. It could also be seen as the money of the business. And there's 4 categories. The first one is capital, the second one is income, the third one is drawings, and the fourth one is expenses. Now, capital increases the owner's equity because when the owner puts money into the business account, the money of the business increases. So the first 2, including the income, will increase the owner's equity of the business. So let's look at income, current income, and other types of income. Now, when you render any service like cutting someone's hair, that will be classified as current income. Then, when you rent out your building and you earn income there, it will be called rent income. And then donation is if somebody gives you a donation and you get donated some item or money or whatever, and that is all classified as income. Can you see that the first two, C and the I, increases the owner's equity of the business, whereas to the last two, which we're going to look at now, decreases the owner's equity. So let's take a look at that. Drawings. That is when the owner takes out money from the business, out of the business account, or he might take trading stock for personal use, and then he takes it out at the cost price. But that will make the money of the business less. The same with expenses. Expenses, there are quite a few of them. Wages is paid weekly, and then salaries then will be paid monthly. But this is from the business point of view. So they're paying the salaries, they're paying the wages. So that is why it's an expense, and that's why it decreases the money of the business. Okay, stationery, again, is like pens and pencils and whatever that you use within your business. Water, electricity, that's very easy to understand. That's a water and electricity that you use within your business for all kinds of things, your bathrooms, your kitchens, etc. Electricity is whatever you use during the month. Consumable goods is things that you use up, like cleaning materials, etc. And then telephone, it could be all kinds of, it could be a telecom line, or it could be classified or under telephone, or also maybe a Vodacom cell phone account could be classified under telephone. Rent expense is when you're renting another property and you're paying the expense, rent expense. Insurance is there to help you to protect your assets. So we take out insurance for our cars, so that if we get into a car crash, that the insurance will be able to pay out to compensate us, and that we can replace the car. Fuel expense, whatever it could be petrol or diesel or oil that you have to get at the fuel station. Repairs, all kinds of repairs of your assets that there's some or other fault with it and you can repair it. Okay, so that is why owner's equity will be C plus I minus D minus E, which means capital plus income minus the drawings minus the expenses. Now you will see if I draw the T account of owner's equity, the plus is on the credit or right hand side and the minus is on the debit side. Then, now what will increase the owner's equity? It will be the capital and the income that will increase the owner's equity. We will put it on the right hand side, but we're going to look at that a bit later. Then on the left hand side you will have drawings and all your different kinds of expenses that you will put on the left hand side, and those two will decrease the owner's equity of the business. Okay, then lastly we're going to look at liabilities. So liabilities is when the business owes other people money, and there are two different groups: non-current liabilities that we have to pay over a period of longer than 12 months. So it could be a 2-year loan, or it could be a 5-year loan, for example. Now, property mortgage bonds is on houses or properties. So let's look at a specific example of that then. That will, if it's a commercial property, it will take about 10 years to pay it off. But if it's a residential property, it's normally 20 or 30 years that you can take out a mortgage bond to pay off your property. Vehicle finance, when you buy a car, it's normally about 5 years that we look at. And then loans could be any term, 2, 3, 4, 5, 10, or whatever years that you negotiate with the person that you're borrowing the money from. Okay, all right. Then current liabilities, lastly, that is loans that the business has to pay back within period of 12 months, or the debt. There's different kinds of short-term debt. Creditors is your suppliers that you borrowed money from. Bank overdraft is when you go and you use more money than you actually have in your bank account, but you've got a facility where the bank gives you more credit. It almost works the same as a credit card, where you use money of the bank and then you pay them interest. And then there's also small loans that you can take out. You have to pay these within 12 months. Then it's a current liability. Okay, so that's a broad overview, but what you need to do is, this is your summary, but the first few pages of the chapter goes into more detail on each one of these if you want to go through that first, and then this is your summary that you study in the end to make sure that you know how to classify all of them. Because if you know the classification, then accounting would be a lot easier. Oh, and then lastly, I forgot to mention that liabilities works the same as owner's equity, and your plus is on the right hand side, your credit side, and your minus is on the debit side. That means I've got more loans on the credit side, I've got less loans on this side. I take out more loans here, I pay back the loans on the debit side. And with owner's equity, lastly, with the two things that I want to mention, is that owner's equity increase on the credit side. So that means if capital and income, I'm going to put the amounts on the right hand side or credit side of the owner's equity account, and I'm going to put the amounts on the left hand side if it has to do with drawings or expenses. But remember, I still put this name at the top when I do the T account. And for assets, I've got more money if it was bank, and I pay out money on this side. But if the asset was something like equipment, I will write it on the left hand side if I've got more equipment, and if I sell my equipment, I'm going to put it on the right hand side. So that's why it's important that you are able to classify these accounts as assets, owner's equity, or liabilities.